Now, the LBMA CME cartel will have to align with the rapid expansion of very liquid, Western accessible Basel III-compliant global exchanges, or completely lose its influence as a gold trading hub.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, brought to you by Kinesis Money. As you can see, I'm out of the vault today and in the jungles of Costa Rica. You know, Live from the Vault is the show that goes way beyond the headlines to uncover the truth about the precious metals industry. And joining us today is Kinesis' very own world-renowned whistleblower and precious metals industry expert, Mr. Andrew Maguire. And this week we'll be answering another question from the Live from the Vault community. So keep those questions coming in. All you got to do is just check on the link below there. And in your own voice, we will play your question for Andrew to answer live on the show. And you never know when your question may be asked. So next time, maybe on Live from the Vault. So let's head over now to the UK and talking gold with Andrew Maguire. Hey, Andrew, can't believe it's just 2 weeks since your last market update, and so much has happened since then. We first had the gold tariff flip-flop, and this week, Trump's Russia-Ukraine peace efforts, all of this into the thinnest holiday market liquidity of the year right here in August. Following the 2 weeks here of Trump-induced volatility, can we start with what's on your radar right now in the markets?
Yeah, great to be with you again, Shane, and thanks for everybody for joining us. Let's rock and roll here and get to so much stuff to go through. And as you say, look, that's a perfect place to start. And then we'll look at Kerry's question. Now, the elephant in the room is the passing of the August 15th, 1971 54-year anniversary of where Nixon ended the Bretton Woods system, announcing the suspension of the the dollar's convertibility into gold. Now, foreign central banks were racing to exchange dollars for gold, and what that was doing was draining US Treasury holdings from 20,000 tons to around 8,000 tons. And had Nixon not ended the convertibility, all US gold would have flowed out. So, you know, Nixon Shock, which was, as I say, on the 15th of August, it priced gold at $35. However, this did not stop foreign central banks going to the marketplace to sell their dollars for gold. And the next day, just one day later on the 16th, the price of gold had spiked higher by 25%. It doesn't seem like a lot because it was $35, but it moved up to $43 per ounce. Now, foreign central banks then continued to go to market to swap their depreciating dollars for gold. And by December 1974, the gold price had risen by 450% to $195 an ounce. And with the gold price getting away from the dollar peg, further and further away from the dollar peg, by no coincidence, this was the very month that the US Comex gold futures market was launched. Now, the Comex was trading long before that in the 30s, but gold had never been a component of that. But so just to really illustrate, in an uncovered 1974 State Department cable, WikiLeaks revealed that in association with the local London 400-ounce gold markets, the Comex had deliberately been designed to create volatility in gold prices. And the idea was to discourage US citizens and foreign investors from holding physical gold by making prices far less predictable and at the same time indirectly supporting the fiat currency stability. In other words, just pumping up the dollar versus gold. And this was enabled by the Comex adding thousands of tons of undeliverable paper gold into the daily trading mix, diluting the real deliverable gold price. Now, official gold price suppression maintenance always required a cartel of market-making bullion banks who through position concentration, they were able to print as much paper gold as was necessary to control a rising global gold price. Now, well, if we now fast forward, and here we are, 54 years later, and we're recording this on the 20th, so 5 days ago, with gold price really in dollars 9,500% higher, averaging $175 per year, 175% per year, at around 3,300 at the moment, or 3,340 or whatever it is. Yet the real story is that gold has not actually risen in price. It's just that it requires 3,300 more dollars just to buy the same ounce, kilo, ton of gold. And what we're about to see is the next pivotal gold price revaluation event, which will once again incentivize every single foreign central bank to race again to swap more dollars to buy the same ounces of gold. Now we'll look at the footprints that assure next year's Nixon Shock anniversary, the 55th one, will come around with gold having been revalued against the dollar. So not only, really, what would my question be here? What is the question? How many dollars will it actually take to buy the same ounce of gold next year? So a similar 55th year, 175% higher physical price would price the dollar gold at around $8,000 to $9,000. Now, US gold price revaluation will first force US gold reserves to become Basel III compliant. So let's just say I wouldn't bet against that. Now, with most of Europe away on holiday over the last 2 weeks, vapor-thin liquidity has given the training advantage to the derivative actors in gold and silver. But while this leveraged supply has driven another opportunity for officials trying to mark as many of remember those Office of the Comptroller bets that have been putting up the charts about? So they want to mark as many of these bets because they relate directly to US Treasury reserves. They want to mark them to market as best as possible into first options expiry into options expiry and first notice day on the 28th. So options expiry is next on the 26th and first notice is on the 28th. But under this short-term chart noise, let's drill down into the footprints which are ultimately leading to a real supply-demand gold price to emerge. Now, over the last 2 weeks of paper-driven tariff flip-flop, a series of gold revaluation footprints have actually been revealed. Now, cutting to the quick, ironically, almost to the day 54 years ago, with the dollar redeemability being usurped by the China yuan one-to-one Basel III-compliant convertibility into gold. So you hold the yuan, it's backed by gold. The irony of it, and the Comex diluted prices being are being targeted through the back door Achilles heel, which is, as we've said multiple times, the exchange for physical mechanism, that little mechanism that allows for Comex synthetic supply to move into the Basel III compliant markets for delivery. So yes, the accompanying dollar-based paper gold suppression tool that finally blew up, coming dangerously close to blowing up the interconnected $2 quadrillion derivative markets, of which gold is the largest, really the largest shoe to drop. Now, let's first drill down into the footprints. Then we're going to report on the very large exit of LBMA CME hedging flows, which is actually going to force these bad actors to embrace full Basel III compliance. We kind of looked at that last time, so I won't dwell on it, but that is what we noted. Now, cutting through this past 2 weeks of, as I say, the thinnest European holiday market liquidity, where a single trade can move the price. This tariff tantrum exposed, what it did was expose the need to quickly address the LBMA CME cartel's paper to physical disconnect. So let's have a quick look into the charts because it's the best way to actually highlight this.
So just to illustrate, following this asymmetrically imbalanced EFP basis funding crisis, forcing an unprecedented $125 premium per ounce to buy back the unbacked percentages of unhedged Comex shorts, just as our liquidity providers had predicted, into the kilobar and 100-ounce tariff confusion. For the first time since COVID physical shortages broke the March 2020 EFP gearbox, untariffed 400-ounce Loco London so-called enhanced delivery contracts began to be shipped out. So this is the first time we've experienced a basis trade blow-up, an EFP blow-up, since COVID, and this time to a higher degree. And sure enough, it took a full week to actually be listed, but on Thursday of last week, the CME evidenced the first 50 times 400-ounce bars arrive into the Fed agent bank's JP Morgan's eligible vault, which now totals 10,134 400-ounce Loco London bars. Now, for reference, total CME 400-ounce eligible deposits equals 4,814,275 ounces, basically 150 tons, which is 12,036 400-ounce bars. That's the total. Now, if officials had not stepped in to plug shortages of available US bullion for delivery on the morning of the 8th, which was really a panicked move, liquidity providers had indicated the cost to cover the unallocated chasm into a bid-only market, at best estimate, could plausibly have driven just the cost to cover basically $1,000 higher, likely around $36.50 at best estimate, before enough physical sellers would actually be attracted to arbitrage this massive derivative risk. However, by that time, damage would be done. Another layer of shorts would have been rinsed and a new stair step at 3,600 would have been secured. While they've delayed it short term, it's coming.
So these imbalances have exposed the impossibility of allowing the Comex, a global-facing major price-setting hub, to set a divergent cash-settled price, which through the EFP mechanism becomes physically deliverable. Now, following a wide-spectrum derivative implosion being narrowly averted, I mean skin of the teeth averted, multiple sources suggest the Bank of International Settlements is moving to enforce LBMA CME cartel NSFR gold compliance. And while the 3 to 5 tons of gold benchmarked at the 2 LBMA fixes are actually a high quality liquid asset compliant and are one-to-one backed by physical gold, the much larger non-compliant unallocated gold shuffled around the cartel's books really dilute the real price.
So while it took COVID to first expose the 100-to-1 paper diluted paper to physical price, if you remember, it was 100-to-1, the price, the EFP basis trade spiked to $100, and I don't think that's a coincidence. This time, it blew right through that gearbox. So 25 years later, the Trump's tariff flip-flop has once again exposed the cartel's Achilles heel. And while the COVID CME LBMA implosion was officially bailed out by the BIS and the Bank of England back here, this time, not so easy to do. Because the Bank of International Settlement had already short-covered all their derivative risk and had no reason to jump in, because basically they'd recategorized physical gold as a high-quality liquid asset and has since synced its globally connected gearbox, enabling the expansion of alternative physical exchanges.
Now, the BIS compliance has enabled a fully compliant, globally fungible, this is key, NSFR compliant benchmark price to be fixed outside the mispriced local London fixes, resulting in the LBMA cartel ultimately becoming price takers. Now, current activity at the unallocated diluted LBMA fixes is largely related to captive producers being forced to bend the knee to LBMA cartel dictates, with arbitrageurs, and that's often the same actors, buying what little is on offer to sell into the SGE, largely aggregated between $10 and $17 per ounce higher price. Really, in other words, really screwing the very producers that they finance. Now, the LBMA CME cartel will have to align with the rapid expansion of very liquid, Western accessible Basel III-compliant global exchanges, or completely lose its influence as a gold trading hub. Now, outside the severely compromised LBMA ring fence, every other global exchange is Basel III compliant, therefore reliably benchmarking a tradable, physically deliverable gold supply demand price. Now, last week's the EFP basis curveball that we showed was the last actual straw. The Comex is seen as no longer fit for purpose, with liquidity providers reporting producer, refiner, central bank sovereign and institutional hedging flows are permanently exiting the Comex. It's unreliable. And the loss of faith in the outdated LBMA CME cartel is driving hedging business into, and albeit yuan to dollar adjusted, the SGE physically backed benchmark, enabling Shenzhen, Hong Kong, we've got Singapore, Saudi Arabia, and then we talked about, we've got good information, there's the Brazil hub is coming online, alongside a growing number of upcoming Western-facing SGE gold hubs, enabling jurisdictionally held bullion to actually be made a bit available around the jurisdictions for a T+0 global settlement. Now, following last week's 24-hour scramble to avert full-scale derivative contagion, liquidity providers assess full NSFR compliance will have to be enforced by the November 28th December contract expiry. That's when the December contract expires, ahead of full Basel III compliance on the 1st of January 2026. This is almost like this is what we saw before the 1st of January BIS compliance on the 1st of January 2023. To understand its physical gold's fungibility that really exposes the Fed-run cartel's weak hand. And now of note, ex-Argor Heraeus director Richard Shellman, what he did was pen a very timely warning in last Thursday's Financial Times, and it was titled, "The Gold Market is Too Important to be Left to Private Clubs," as he put it. Essentially, what he's doing is drawing attention to the EU's recent warning of very large unallocated non-Basel III compliant derivative risks, suggesting the LBMA club, Reed cartel, needs to be reformed. Now, the EFP basis dislocation was directly caused by the cartel being unhedged, unable to deliver unallocated gold to hedge physical gold, being called for delivery. Now, the article draws attention to the most recent disruptions that drove this EFP basis spread to an unprecedented $125, which came close to triggering this interconnected derivative implosion, with LPs now reporting asymmetrically balanced Comex hedges are significantly being curtailed. In fact, most compliance managers would not allow, and much like we saw after COVID, most compliance managers with the second tier banks said you no longer use the Comex as a hedging tool. Obviously, a lot of other people do. So do the CTAs. It's no longer reliable. There are alternatives. And our LPs view this as another step that is leading to a necessary full NSFR global compliance ahead of an inevitable US gold price revaluation. Now, connecting the dots, it's no coincidence that gold revaluation talk has moved onto the front burner. There's just a few connected bullet points I kind of just get into. So, into an unprecedented short covering move, as we previously illustrated in screen captures taken from those Office of the Comptroller reports, the two Fed agent banks, JP Morgan and Citi, had moved to close all their 5-year OCC unallocated FX gold and silver bets. That was a big clue. Empirical evidence suggests it is these siloed, unbacked FX gold bets that, and they're completely unbacked, that directly relate to and asymmetrically hedge the rehypothecated US Treasury holdings. Now, with the competing SGE, the Enbridge, the 7-second T+0 settlement platforms increasingly dictating a real supply-demand, non-dollar denominated physical gold price, the LBMA CME cartel will be forced to become full price takers, forcing the Fed to short cover by buying back these unallocated bets at market.
Now, back in November of 2022, and as we shared at the time here on Live from the Vault, our liquidity providers were 100% on point when they were advising that the BIS was calling in and squaring all the remaining LBMA derivative bets, repatriating gold back into their sight gold accounts that they manage for central banks. Now they assess that the December futures contract expiry that's coming up on the 28th of November, these OCC bets related to US Treasury gold will be sufficiently Basel III-compliant to be audited and revalued. This means a lot of Fed buying, just as it did back in November 2022. And we take this information on board and we're going to gear up for it, looking to exploit this window of opportunity to buy deeply mispriced gold and silver. And we've also evidenced the Fed repaying their BIS leases into a series of higher physically supported stair steps. We've tracked it over time and also in the futures charts, which we've tracked month after month after month, apart from one instance, the Bank of International Settlements has been forced to close to square their bets at higher and higher prices. These are higher stair steps. However, the point we're making is, with legitimate hedging activity exiting the volatile Comex exchange into Western-facing SGEI physical benchmarks, residual Comex available at spec open interest is getting too thin to short cover into. Therefore, liquidity providers assess we're going to likely evidence a similar short covering move that likely mirrors the BIS exiting all its 500 tons of gold derivative bets 2 months ahead of gold being revalued as a first-tier high-quality liquid asset in January 2023. So we should expect a similar buying back, with the Fed this time buying back their bets, whereas before the BIS bought back their bets.
So next, and we're going through these sort of bullet points really, as we go through the gold revaluation footprints, it's really no coincidence that the Fed published a study on the pros and cons of revaluing gold. Now, the Fed has never, ever discussed gold before. While this was a hastily put together discussion on the subject, on a subject they've always denied was ever on their radar, and very likely an attempted pushback against all the White House-friendly gold talk, we have reliable information from a close contact at Goldman that the Fed is being prepared for US Treasury gold price revaluation, likely in tandem with the new Fed chairmanship. With most bullion banks long gold for their house accounts, The short positions ultimately sit on the Fed's balance sheet, forcing them to bail out their agent banks, stick handling these unallocated bets. Now, the only way to rebalance is to bring US gold markets into Basel III compliance and then revalue gold to market. You can't do it the other way around. It's also highly probable, this is interesting, that the gold tariff tantrum was a deliberate trial balloon. Now, look, it was very well coordinated, and despite driving unprecedented EFP basis spreads to expand to really, and they were unprecedented levels, coming close to a basis car crash, Trump waited a full 24 hours to clarify gold's status as money. Now, that really gets your attention. We're not the only ones thinking this was a warning sent to the Fed, and the White House has made it clear that they're pursuing a mandate of depoliticizing the Fed, taking control of the new Fed chair, of interest rate policy. They're talking about the putting the BLS non-farm payrolls data, these manipulated releases, which they refer to as manipulated, on hold. And they're telegraphing to the Fed, which is the only central bank still suppressing the gold price against the dollar, that gold will be revalued.
Okay, Andrew, you mentioned the thinner holiday season and market conditions that we're in right now. I guess the season really will start on September 1st. What are you expecting in the very short term here?
Yeah, so very short term, into the end of this last thinnest 2 weeks of the year. And of course, with most sitting on their hands ahead of the Russia-Ukraine deal or no deal being announced, these illiquid conditions are given the advantage to the automated naked short momentum sellers, which is, and technical traders will see, basically encouraged to short sell, automated short sell on below the 50-day moving average. That should have nothing to do with anything, but it is nevertheless a driver. But here's the rub. Trump wants to exit, as he puts it, Biden's war and move on to dealing with China. Now, bottom line, very short term, the ebbs and flows of this geopolitically driven process will continue to see gold and silver range in thinner conditions, but there are very, very, very large central bank bids at spot 3,300, which there's no surprise they were front run. And liquidity providers indicate these are large enough to continue to get front run.
As suspected, the momentum-driven attempts to exploit the European holiday market conditions to target a full gap close, this being a full gap close, confluence with the rising spot-adjusted 33.52 100-day moving average, was capitalized on by Asian SGE buyers overnight. We're recording this on Wednesday, and this was a point they front ran this by $1.30, knowing there was large whole aggregation of short covering bids at that level. So it was pathetic, really. While the momentums were seeking to close this gap, if you remember, this was just simply a recovery, a physically driven recovery ahead of first notice gaming last month. So here we go again, end of month, and we see some gaming. But it's getting harder and harder and harder into higher stair steps to be able to pull this off.
All right, thanks, Andrew. And just a reminder to the entire community, if you have a question for Andrew Maguire, you want it answered live right here on Live from the Vault, just look at the link below. You can click there and you can record in your own voice, speak directly to Andrew, and we go through all the questions. And with that in mind, we have a question this week about silver from Kerry. Let's go ahead and play that question.
Hi, Andy. It's Kerry. I've been following you since the London GABA days, probably over 15 years ago now. Question is, do you see a scenario or point in time in which smaller nations, other than the top, say, 10, 20, or 30 that are major gold buyers for their sovereign accounts, do you see these smaller nations going to silver as a tangible reserve asset for their central banks and treasuries? Thanks.
Yeah, Kerry, great question, as this is exactly what we're seeing now that silver market paper settled liquidity, alongside producer financing initiatives, are rapidly leaching out into the Chinese-backed 7-second settlement BRICS-facing physical exchanges, where you have to own a bar before you can buy and sell it. Now, very short term, thin holiday market liquidity aside, in the larger picture, silver has largely escaped the LBMA stranglehold, opening up buyers from all over the world. Now, historically, up to 501-to-1 paper to silver position concentration, that is, yes, 500 paper ounces to 1 paper ounce of silver. That position concentration was admitted by industry apologists in the past, and it's enabled the LBMA silver cartel to have full control of the cash-settled unallocated silver foreign exchange market. Now, these synthetic silver fixed prices have historically been so diluted with unallocated, undeliverable cash-settled silver contracts, they don't reflect a real price, whereas central bank sovereign buyer, which you refer to, where they could take delivery, is just too volatile. And bearing in mind, the underlying leverage bars have diluted the real physical price. So absolute chaos. Now, the trouble with local London pricing, it's been so dilutive of the real physical price that 3 things really have come into play. Massive injected price volatility. And if that didn't dissuade a buyer from looking at silver as an investment asset class, if delivery actually was demanded, extremely large premiums over the spot fixed price had to be paid to obtain physical bullion. In other words, bilaterally settled, completely different, separately to what this ludicrous fixed price was. And this has made a farce of the global fixes. But even worse, very large physical orders have been refused. And we've experienced this in the past ourselves. Now, because a very small group of LBMA bullion banks controlled really the legacy silver market, they're no longer fully controlling it. And yes, we're talking about UBS, Deutsche Bank, JP Morgan, Scotiabank, and satellites. What they would do is they'd lock down the bullion banking arrangements with the refineries, alongside forward purchasing all the refineries' annual production. So any buyer seeking to backdoor it and circumvent the cartel, because it hit the banking network, there was immediately red flagged, warned, and then you'd receive a warning that you'd be blacklisted if you persisted in trying to take delivery. Now, however, with silver now being priced in real physical exchanges outside the LBMA cartel's influence, where a seller of a silver bar has to first own it and a buyer of that bar has to take physical ownership of it, a real physical price is beginning to emerge in the SGE benchmark exchanges, where it's now possible to buy any quantity of silver at a physically determined supply-demand price. And with volatility greatly reduced, hedging these purchases is far less expensive. And that makes it very attractive for other national currencies to invest in silver. And so, yeah, Kerry, just as revealed by Russia, which is, again, the 8th, I think we covered this last time, but it's the 8th largest gold producer. And they're aggressively stockpiling silver as a tangible reserve asset, with silver now available in any size for small nations to access. This largely unfactored real physical demand is going to drive a much higher true supply-demand price. It's just starting to evolve. The local London fix is still dilutive, but increasingly benchmarks a direct producer to end user price. So any discrepancies are being arbitraged. Now, LPs report continued accumulation of underpriced LBMA CME silver is currently in the BRICS crosshairs. So with US-driven silver futures, we just saw it again, while US silver futures got sucked into the thin liquidity vortex this past week, LPs indicate there's too much physical interest at spot $38 for it to be kept below. And obviously, we saw because the options positioning suggests 37.30 as the option sweet spot, and that the Fed has a silver short position, OCC silver short position through its agent banks, you can darn well expect that they are behind, trying to market below. They don't have silver. They can buy gold, but they can't buy silver without disrupting the entire silver ecosystem.
Now, of particular note, and far too obvious, was Tuesday's farcical futures-driven sell-off that waited until silver had fixed, and then synthetically drove the spot FX silver price trade into an overnight Wednesday, this is the Wednesday lows, 9-cent premium to backwardated silver futures. In other words, the spot premium was trading at 9 cents an ounce higher than the futures market price, literally making a farce of this whole futures market, this price discovery mechanism. It didn't go unnoticed, and it's been arbitraged. And there'll be a price to pay as very large buyers locked in these massive futures discounts for physical delivery. And just as we saw as we saw in August gold futures, its first notice, and the physical buyers coming in, evidencing the largest on record backdoor bullion loadouts in gold, this month, September silver expiry next week will also evidence massive backdoor loadouts. SGE, Indian and Saudi buyers use dollar strength to exchange for silver overnight, hence the 9-cent premium in spot. So despite all this faffing around, no damage done. All it's done is expose the silver futures backdoor for an enormous loadout.
Here are a couple of really interesting silver observations. Here's a couple of links to look at. And both gold and silver futures are coiling into oversold conditions. Now, looking at gold as well, UPS, here's a link for UBS on gold. Here's a link to Citi on gold. Here's a link that illustrates how GDX, the index, is front-running a gold breakout. What's interesting about the GDX is it's much harder to hide commercial footprints in GDX. And here's a link to Bank of America Hartnett, his latest piece. He is talking about really gold is suggesting that people raise the CTAs and people raise their allocations to gold and crypto because yield curve control is coming. Now he's pretty right on the button. So there's just a few little links. I'm not going to grind on about them. They're just there. So while automated US-centric leverage, the dollar, we've noticed the dollar rallying. So we've had US-centric leveraged dollar to gold futures inverse sellers, taking advantage of the dollar strength to sell leveraged, unallocated, undeliverable gold against the dollar. What the liquidity providers report is unleveraged physical buyers are capitalizing on this dollar strength to actually sell dollars to lock in spot gold and silver for a T+1 delivery. This is going to blow back on the shorts. So really, to sum up, cutting through the short-term chart noise, the message I'm really getting from everywhere is a gold price revaluation is a certainty. And with the Fed, the last central bank finally capitulating its gold price suppression efforts into an already strong for demand physical market, the window of opportunity to get ahead of the next pivotal 54-year, 175% per annum share of 9,500% gold price to dollar appreciation is now. So what's it going to be? 1 year from now? My question is, how well is your stack positioned?
All right, that wraps up another episode of Live from the Vault, brought to you by Kinesis Money. And a big thank you to Andrew Maguire for sharing his deep market knowledge. And thank you to Kerry for the question of the week. And to you also for being a part of this growing global community. And if you're new here, make sure you subscribe to the channel and tap the bell there so that you never miss a show. We'll send it to you as soon as it goes live here. And if you've been with us for a while here, like many of you have, help us keep spreading the word. Give us a like right now. Just hit that like button and share this episode with someone who really needs to hear this information. So get your questions into Andrew Maguire, and your question may be selected for next week's episode right here on Live from the Vault. And with that, we'll be back next week right here with more truths that you won't find on the mainstream media. And until then, buy physical, make sure it's backed 1-to-1, and we'll see you next week. Bye for now.